Another important early experience that you had that relates to some of what we talked about, I think, was while you were at Wharton, where you had this CEO from, I think, the Golden Nugget Casino come through. Can you talk about that? Because it also relates to this, really to the philosophy that you've had as an investor that stood you in very good stead for the last 35, 36 years.
Yeah. So, I mean, even, I was in elementary school, I'm a sports nut. I love it. I started I think, this probably date me, but I think I had a 25 cents for my lunch money, and I used to bet it on, oftentimes, which made me hungry at times, but bet it on Chiefs Raiders game or what have you. And so I was always intrigued by taking risk and then by the way, I would do this research on how they played on turf and versus otherwise. Anyway, but then, then somebody came in and spoke at Wharton, and I learned a ton at Wharton. I learned a lot about dealing with people and people from international spheres. And anyway, but somebody came in and they spoke about, he said, well, how do we make money at casinos? And I raised my hand and I said, well, the odds are in your favor. And I gave all the chapter and verse, the statistics of what the odds, and he said, actually not. He said, people come, the odds aren't that much other than slot machines. People come with $200 in their pocket, and when they lose the 200, they leave. And I kept resonating with me, because what happens is you think about how, similar to the way markets, they oscillate up and down. And I thought about, gosh, when you oscillate, you hit the down 200, you leave. So almost, statistically, you're always going to hit the down 200 if you stay there long enough. And more it hit me about investing. It's there's going to be something exogenous, whether it's geopolitical, whether it's some company's fraud or something. There's always going to be something exogenous going to have you hit the down button. And so I always try and think about what are the things that prevent me from doing that. And then, because markets oscillate, try and be, it sounds cliche, but try and, sell when it's going up and others are buying, and vice versa, take your profits along the way. But the big deal for me was thinking about, markets tend to move in trends, and they tend to move in trends around a trend line, but they oscillate, and based on noise and news, et cetera. But then just make sure you don't hit. And what are your stop gaps around your position? What are your hedges, so that I don't want to be that person that that hits the down button. Particularly, clients. I've had, like I say, I've taken losses over my career, and I just want to make sure that I'm trying to insulate from that. But it just emblazoned in my mind the philosophy around the random walk alongside of a trend, and just make sure you're being thoughtful about optimizing it versus being on the wrong side of it.
Yeah, it seems like a huge part of your process is, or your success is simply this avoidance of catastrophe. The fact that you've managed to stay in the game, whereas a lot of very talented traders, very talented investors have just blown themselves up. I remember you once saying you would watch a great trader who'd get three bets right and then would blow themselves up on the fourth trade. Can you talk about that? What's happening just in human terms that people temperamentally, as Ben Graham would say, we're our own worst enemy as investors?
So I'll say the first thing. I really don't regard myself, when you say successful, I always think, and part of what motivates me is I don't really regard, I think it's a constant challenge. I look back and I say, there are things I should have done, or things that, I think part of what motivates people to not be in that where you blow up. It's I don't think I figured it out. I don't think I think we do some good things, and you get some, recognition for doing some good things. But, I think what happens is, and I studied this it was really cool. We did some things on, to look at, who succeeds. And it's interesting and it happens to be more in males, that there was this dynamic around where you build a confidence level. And I'll never forget this study that showed tennis players. I'm not sure I talk about tennis. I prefer golf, but tennis players, when they are set up, how men tend to try and go for it. And when they're ahead, they tend to go for it. And I see this all the time, is people who get 3 out of 4 trades right, and then they're down money because their confidence level was too big, their positions got too big, and then the fourth position hurt them. Or the fourth position wasn't scaled to what is the downside versus the upside. And I think that is such a big deal, is, so part of my philosophy around in fixed income, in bonds, mature at par or they go down. And so I always say, make a little bit of money a lot of times, make a lot of relative value decisions, try not to have that one trade blow up to 3 because in bonds, if you're wrong, they go down 80 points and you're hoping to get paid par 100 cents on the dollar. So, this idea of don't get overconfident, don't have one business, even though it's working, don't get overconfident. And I see it all the time. I mean, all the time with investors, traders that, you see the confidence levels growing. I just had a good trade, another one. And then they end up getting hurt. But I think it's a really big deal around investing or trading.
I really want to emphasize for our listeners the importance of that line that Rick just mentioned, which is kind of a mantra or motto of his, which is let's make a little bit of money a lot of times, because it's so central to Rick's approach of really not so much swinging for the fences as diversifying thoughtfully, trying to survive, trying to get relatively consistent returns without huge downside. But in a way, it's curious to me, Rick, because it's sort of the opposite in some ways of the approach of someone like a Charlie Munger, who we've read about a lot in the last week and who I've interviewed in the past, and who just passed away a few days ago. Because Charlie would talk about being a spear fisherman who would sit by the side of the stream and just wait for one big, fat, juicy salmon, and would then spear it and then go back to doing nothing. So in a way, he was a great advocate of, at least if you really know what you're doing, having a very concentrated approach where, because you don't know that many things, you wait for something that's a really great opportunity, and otherwise you just don't do that much. And you, in a way, I mean, there are so many different paths up the mountain, but I wonder if you could unpack for me the difference, because there's something very different philosophically and temperamentally going on here that you embody.
I'd say a couple of things. The first one is I think equity and debt and bonds are very, very different. I believe in equity, and similar to the description you had, in equities, you should concentrate more because they are convex to the upside. So you think about companies throw off return on equity, whatever the numbers are, and particularly tech companies, venture companies, you can, if you're in the right zone, you can multiply your profits, multiply your revenues. And so in equities, I actually believe in concentration, scaling your positions the right way. And if you really believe in something, you can grow it. But bonds are different, and because of they are convex to the downside. So in bonds, I feel like this make a little bit of money a lot of times, diversify. But I like in equities, I actually like scaling. So some of the companies, that are invested over the years that I really, really like, including today. I mean, we take bigger positions, and I think, and not only take bigger positions, we use options to try and amplify the upside of it. So I think that is one part of it. Second is, I think it depends who you are and what your objectives are as well, in terms of, are you, we're managing money for clients, and, whether it's policemen, firemen, teachers, et cetera. And, I take it quite seriously that, it's their retirement, it's their well-being. And, this idea that I'm going to swing it and, what I'm trying to protect is, grow their retirement pool in a deliberate, efficient way, without that big downside. I mean, if you're managing your own money or you're managing your own, whether your own specific, you're willing to take risks because you're willing to take your own personal downside. I think that's a very different framework. I also think a little bit different. Berkshire's a pretty unique place, but, it also depends on the scale that you're operating in. We run a lot of assets, and, the scale, the idea of we're going to get out if we've made a big risky decision, pretty darn hard. And, I think, if you're an insurance company, you have long dated liabilities, your holding period can be 20 years. We get measured, our clients, depending on who the clients are, we have some that are in very liquid funds, look at returns almost every day. And so, do you have the ability to hold on for 20 years? So, what is your investment objective? I tend to think of most of our portfolios, tend to think of things in 6-month increments. It varies. If it's a private investment, I've got a longer throw to it. If it's, something like treasuries or duration, I'm shorter. So it depends on, who are you investing for? What's your objective set? How big is what's your scaling? Is it debt versus equity? And so I think all of that goes into the equation.
I think also what you just said about the ability to hold on is really important. And I was very struck by a quote of yours that I'd read where you said, I've always found when I've invested in credit or equities or anything, there are only 3 things that matter for investing. And they're leverage, liquidity, and cash flow. And you talked about how if your leverage is high, but you've got plenty of liquidity and your cash flow is high, you're okay, you can survive. But so you said it's all about how you can service my debt. And in a way, it goes back to that very early experience where you got blown up on that Canadian bond.
Yeah. Yeah, no, it's quite an honor that we learn these things or look at these things. So, I think I literally think there's only three things that matter: leverage, liquidity, cash flow. And I've learned that you can run a lot of leverage. And by the way, I think this is an acute problem for the U.S. government today. You can run a lot of leverage as long as your cash flow exceed, as long as you have a liquidity. If you run out of liquidity, it's over. And so you got to know deep down, what is your liquidity and what can disrupt your liquidity, because it's game over if that. So to put that aside, then it's your cash flow versus your leverage. You can run, like U.S. government, you can run a lot of leverage as long as your cash flow, your tax stream or your revenue stream is high enough, and your cost of the debt is, meaning your cash flow exceeds your costs of the debt. So your cash flow is high. And, I think for the U.S. government, it's a really big deal. If we're funding the country at 5.5%, it's different than when we were funding at 0 or 1% for a long time. So, and to me, that is the whole deal. And I look at everything, whether it's an equity, whether it's a bond, whether it's a piece of real estate, leverage, liquidity, cash flow. And, it can, different forms, how much emphasis you put on each of them, that those are the three things on every single asset. I would challenge people, like, I'm an illiterate, not that I necessarily have it figured out, but I feel like I can put I can take everything and figure out those buckets, and then say, if it's sophisticated, tranched, CLO, real estate securitization, and you've got super senior down to equity and mezz, and I just want to know those three metrics, and then where are you in that spectrum of, are you at the top of the stack, or the bottom of the stack in terms of how your cash flow gets to you? And I know really feel like you can isolate any investment that way. And I
remember as a very naive, still pretty naive, but I was even more naive in my early 20s. My brother and I bought an apartment in New York because he wanted to be nearer to this girl he was dating. And I didn't want him to get rich without me. So I bought a small stake in the apartment, and then it was the late 80s and the property market kind of collapsed. And we were so naive. We had an adjustable rate mortgage and interest rates went something crazy. Like, I think we were paying something like 14% or something crazy. And I was a young writer. I didn't have much of an income. And I remember the terror of having lots of money going out and not that much money coming in. And I think in the same way as your early experience with the Canadian bond that went wrong, I just never wanted to be in a position ever again where I was caught short, where I was at risk of just finding. So I've just always lived within my means, and I've never had much debt. And I think it was just so when I read you talking about just the importance of liquidity, it just deeply resonated with me personally, I think.
So, I find it, like, I look at a lot of companies in venture space, and, and they grow, some of them are very pragmatic about how they grow. And because they've got to, usually they burn a lot of cash because you're building the business, you got to spend on R&D and CapEx and hire people, and you just got to grow. And so oftentimes you see where they grow too fast and they're not managing their liquidity effectively enough. And you could have the greatest business model that will explode, and then it doesn't, and then all of a sudden, like, something happened exogenous and your liquidity dries up, and that this unbelievable business model goes away. And I think it is, I think you have to understand that when you think about it in real estate, like, I've made some sales of like you were describing, early on, where, like, the market went down and, like, I didn't have any money. And so you've got a seller, you've got to, figure out something, and you sell at a price that you don't want to sell at. And so I think you just got to make sure your liquidity, like, that to me is the first thing. And every day we're looking at new investments, and particularly when you're looking at equity or venture or more speculative investments, and, like, have they thought through contingent liquidity? There's a lot of things you could do around bank revolvers and things about what is your contingent liquidity if X hits the fan. And to me, that's such a big deal.
I also think it's worth emphasizing the degree to which you've seen chaos on Wall Street and you've managed to survive and navigate it through a mixture of smarts and good fortune. Because you joined, and there was a very significant amount of good fortune because you joined E.F. Hutton, if I remember correctly, in July 1987, and then October 19th, 87, we had Black Monday, and the Dow fell 22.6% in a day. So this firm that had been founded in 1904 is suddenly forced into the arms of Lehman Brothers for less than $1 billion. So you then move to Lehman's training program, and then you work at Lehman basically for the next 19 or so years, and then you leave Lehman right before Lehman goes under. And Lehman, this firm that was founded in 1850, suddenly implodes and is like the biggest bankruptcy in U.S. history. And I think it went from basically being the fourth largest investment bank in the country with 25,000 employees, including a hell of a lot of really talented people, to suddenly just being gone in the blink of an eye. And I wonder if you could talk about what those experiences of actually seeing E.F. Hutton and Lehman, these two great kind of august institutions with plenty of flaws and plenty of human failures and the like, what impact that had on you in terms of understanding how we live in a world of entropy where things fall apart.
And I mean, you said something that I think is people don't realize. I mean, even at E.F. Hutton, I don't remember that well, but I think about all the people at E.F. Hutton that have gone on to do some pretty incredible things today, that are doing some pretty incredible things. People I was, as just a trainee, I had a lot of respect for, and a lot of them just done extremely well. And obviously Lehman the same. You can have a business that's got an incredible number of talented people and innovators and thoughtful practitioners. And then, you just got to think about, the business model all the time. And what is, not to go back to that point again, but what is the business model? Are you managing your asset liability mix? Are you managing your contingent liquidity? You're managing for that, very, very tail scenario. And I watched some of the companies, that I think have been successful over the years that have had, tough experiences, but, Apple's a pretty incredible story. You watch about, how Steve Jobs managed, the failures out, but then he, had different ways to manage it, and how he raised Google as well, and how they managed, through some more stressful periods, and, thought about, you've got to evolve, you got to innovate, you got to change, and you got to think about the same point about just don't let the business model in a, or your structure, your capitalization, your lack of liquidity disrupt that. And it's a pretty, even with the most talented people, you can certainly, if it's not structured the right way, you can have like epic disruption that ends the game.
It's also quite striking the degree to which luck plays a role, right? I mean, I remember Howard Marks once saying to me, it would sort of break his heart that he would see these people who got washed out at the age of 50, who were just really talented, and they just got really unlucky with where they happened to be when things fell apart. Can you talk a bit about just luck? Because it seems to have played a huge role in your life, and obviously you're dealing constantly with markets where things can just go against you, that sort of undeservedly, and can kind of hit you really painfully.
I'd say, finally, being lucky, I found, is generally the, you usually put yourself hopefully in a position that is, more designed, that is not just based on fortune. But I've had some pretty bad, I would say over my career, like you say, some things that have worked against that are just like surprising, and bad luck, or being, but I think the only thing you can do is try and orient yourself in a place where that misfortune at a given point in time, you've tried to anticipate in some way how you would manage through it. But listen, I think, I've always found, like, you see a lot of people in this industry who had like one good trade, and I would say maybe some good work and a lot of luck. And then they try and replicate it over time, and they're like, it doesn't work the second time, the third time. And I found this with trades and investments. Usually if you have a great trade, and you're like, and then you think about, gosh, I remember that. That's, that happened, and I'm seeing that again. It never is successful the second time of the same amplitude that the first time, and usually it doesn't work. And so you always think about, like, if you've done your work and you're trying to think about, like, there's a series of environmental conditions that are probably completely different from the last time you did something that worked, and then just think through what are these new environmental conditions that can make that successful or not. But I'm pretty blown away by, you see a lot of people that have the one big hit, and then it's hard to replicate it. And then you see a very, very select few I wouldn't necessarily consider myself in this. There are a very, very select few that seem to get lucky on their positioning of their ideas more often. And I tend to think that through a lot of guile and work and thoughtful positioning got to that position.
Well, we'll talk about this some more because I think a lot of I want to talk about two things that I think have been really key to your enduring success. One of which is sheer intensity and drive, and one of which is an obsession with data. And it seems we could start with either of them because it seems to me they're both so central to why you have actually survived in this business. I mean, part of it seems to be. I guess the good fortune that you ended up at BlackRock, right, where you'd set up this hedge fund in May '08, right, a credit hedge fund, right before Lehman went under, and Lehman had a stake in it, BlackRock had a stake in it. So then you go with your team of about 42 when everything goes haywire in the bond market and the fund got clobbered. You go work at BlackRock. So you had enormous access to incredible amounts of data and human intelligence there. How is just the fact that you have enormous data resources really been kind of the central advantage, the central edge that you actually have these days?
I think it's all about, part of why I was so intrigued to come to BlackRock, we had a tough go, and then things were doing better in '09. And part of why I was so intrigued by coming to BlackRock is it was, at the time I thought, the epicenter could be the epicenter of finance. And, it's turned out to be more so than I certainly would have anticipated. But, risk management tools, analytics, we have a system called Aladdin. That is pretty incredible. It allows me to stress test, scenario analyze, look at return attribution and what's daily, what's going right, what's going wrong. And that data is extraordinary. And, your ability to you can make some bad calls. I do make a lot of bad calls. As long as I know, because I've stressed it, I've looked at the scenario analysis, as long as I know what's my downside, how will it impact the rest of the portfolio? How does correlation work? So if I'm wrong on one thing, does it impact the other parts of the portfolio, or will other parts suffer at the same time? That to me is the whole gig. If you have, this incredible, anticipating markets or the economy. So I don't understand top-down investing at all. I'm very much bottoms up, and meaning I study companies. People follow surveys, I think, way too much to understand how are people leaning. And I think these surveys are crazy overstated in terms of influence. But if I can study, why is a company spending on R&D, or why are they laying off people, or why have they grown, why their inventory levels up, what has driven their inventory levels up? And then if you look at it across a series of companies, and all of a sudden you can say, okay, now I understand why employment and the economy is starting to slow or what have you. But that's the only thing I think works. I think trying to do it from the top down, I just don't think it's durable, because you don't understand the underlying catalysts or instigants to drive the economy or a certain sector of the economy. So I really believe you got to get, intent. Part of what AI is so exciting is the ability to do this at scale, and to actually run models and run AI to say, home builders, what's happening in home builders around, how much have they had to provide in their own financing to drive their business? And if you could do it over scale and look at different, it's a fragmented industry. Well, if all of a sudden I can look at the industry through AI, boy, that's pretty darn exciting. So anyway, I really believe in that you got to start from the bottom and work your way up, and assimilating as much data into your process is a key to that.
So you have access to more data than almost anybody, and in a way that puts you in a more extreme version of the challenge that most of us face, which is somehow distinguishing signal from noise, somehow figuring out what actually is relevant. And you do these kind of legendary monthly calls, right? I think over 1,000 people sometimes call in for these calls to hear you opine about the markets and the direction of the economy and the like. And I wanted to get a sense of what your process is, where you're taking this immense amount of information, this immense amount of data. A lot of other people, I guess, have access to some of it. But you're kind of somehow crunching and distilling and synthesizing it so that you can take a view, so that you can kind of point the ship in the right direction and then and then kind of trade within that framework. What the hell are you doing? What's the process, and what can we learn from that about how to distinguish real news from just noise?
So, I mean, I think that's one of the keys to investment. Part of the great investors I've seen is just the ability to actually isolate. That's an important piece of news. So the only way, and maybe it's embarrassing, it's somewhat archaic. Like I look at, I brainstorm with my team, and we say, I throw out some ideas. Well, what about this? What about that? What about this? And then the team starts to pull a bunch of the data and put it on graphs and look at tables and what have you. And then I literally spend, like on a weekend, this is crazy, but I spend on Saturday, Saturday when I do these monthly calls, I mean, a good 10 hours, and then Sunday probably about the same. And then I try and literally look at all the data and say, and then, you get these aha moments, and maybe it's just, like I say, archaic, that it takes a while to think of, like, why is dollar yen doing what it's doing? Why are 2-year swaps doing what they're doing? What's happening to the cross currency basis? And like all of a sudden, and then you see like some things tend to like come together, like I got it, and I got it. And I think the only reason why I think so many people dial into these monthlies is, we try and take all this data and put it together in a somewhat cohesive pattern of, well, this happening and that's happening and that's happening. The conclusions should be X, Y, and Z, which are not always right. But the idea of you take so much intense data to try and come up with your set of conclusions, and I just haven't figured out another way to do it. And like I say, AI is helping us get more of the information and the data. And by the way, I work with counterparties who help me with a ton of it, who have their own internal systems or see flows or research. And then they help me and they send over a bunch of information based on, I'm trying to go down a certain stream of investigation. And then, they're like, I'll put it together. And by the way, like 90-something% of what you really is like noise, is garbage. I'm like, okay, this is happening because somebody was long or somebody was short, and it's driven the currency to a certain level. And you try and like, okay, that doesn't make any sense. But all the, these pieces seem to have a cohesive stream to it that, and so I tend to move my position around more around those. Thankfully, they're not weekly, or I'd be divorced. But thankfully, my wife lets me spend 1 weekend a month socially isolated, and try and put all these things together. But I found it's like the critical node to our, to how we position and we manage it. But thankfully, I think a lot of people have found them interesting.